balance of payments. This is our last topic of macroeconomics. Let us first talk about its structure. First thing, balance of payment is an account. Like you study other accounts, it is also an account. The name does not convey anything. So let us first talk about the name itself. Payments of what kind? Here payments refer to payments to and from foreign countries. And you know that payments to foreign countries and payments from foreign countries are not made in rupees as far as India is concerned. They are made in foreign exchange. What is foreign exchange? We have learned in the last lecture. Any currency other than the domestic currency, in case of India, any currency other than Indian rupee is foreign exchange. So payments here refer to payments to and from foreign countries. So broadly you can say it is an account showing payments to and payments from abroad in foreign currencies. Those who have offered accounts in class 11 and 12, they are familiar with one of the accounts which they study. The account is flow of funds. Flow of funds, funds flow account. This account is similar to that flow of funds account. If we remove the word funds and instead call it foreign exchange, then it is a flow of foreign exchange account. Just like in funds flow, you record flow of cash to and from. In balance of payments account, we record flow of foreign exchange from and to. We call it sources, payments from abroad, sources of foreign exchange, payments to abroad, uses of foreign exchange. In the accounting language, sources mean credits and uses means debits. We will also use the word credit and debit here. Two records: credits for inflow of foreign exchange and debits for outflow of foreign exchange. This is broadly the structure, the meaning of balance of payments. The word balance here means nothing except credit minus debits, that is net inflow. So balance here means net inflow, of payments here means foreign exchange. So net inflow of foreign exchange You also know in every account credits must equal debits, that is the rule. But here when we talk of credits minus debits, we will talk of part of the account, not whole of the account. So in part of the account it is possible credits may not be equal to debits. So if its credits are higher than debits in part of the account, then it is positive inflow. Of foreign exchange in that part of the account, or we can call it balance. So balance here means inflow minus outflow. If inflow is higher than debit outflow, then it is called surplus. If inflow is less than outflow, it is called deficit. So we will use the word deficit and surplus when we explain these accounts. We will not go into the minute details of the account. That account is very long. In my book you can find an example of this account. Here we will talk about only the broad aspects of the account, the broad structure of the account. The broad structure of the account is given here. Refer to this structure. Balance of payment accounts has broadly two parts: current account and capital account. This distinction between current account and capital account is similar to that of your distinction between trading account and balance sheet. All inflows and outflows which do not affect capital position of the country or which do not affect either assets, which assets? Foreign exchange assets, which do not affect, remember, foreign exchange assets or foreign exchange liabilities. They are recorded in the capital account. Those inflows and outflows which do affect, which do not affect liabilities and assets, they are recorded in the current account. To repeat, in the current account we record those inflows and outflows which do not affect either liabilities, foreign exchange liabilities or foreign exchange assets. Those which affect either foreign exchange liabilities or foreign exchange assets, they are recorded in the capital account. Keeping this broad structure in mind, let us see what are the broad components of current account. The broad components are two: merchandise, invisibles. Merchandise is also called visibles. It is also called visibles. So broad division is visibles and invisibles. Why do we call them? So we have seen there are two broad parts: current account, capital account. Let us first talk about components. We said there are two types of two parts: visibles and invisibles. Visibles mainly include merchandise, mal, saman. Why do we call them visibles? Because we can actually see these goods being exported and being imported in physical terms. So, visibles refers to exports and imports of physical goods. So, it mainly means exports of goods and imports of goods. Then invisibles. Invisibles are also exports and imports, but they are exports and imports of services. They are merely bank transfers. That is merely flow of currency, which we do not see. Therefore, they are called invisibles. It has three components: exports of services, imports of services, income receipts and income payments, transfer receipts and transfer payments. Exports of services, imports of services, you know, insurance services, shipping services, or any other services provided to foreigners abroad. That is export and import. Income receipts, we invest abroad, get profit. Getting a profit is income receipt. Foreigners invest in our country, we pay them profits. That profit is our payment. Like this, payments and receipts of dividends, payments and receipts of interest, or any such kind, they are all included, or you can say basically factor payments. Factor payments, they are included in income receipts. Then we have transfer receipts. There is a tragedy in Uttarakhand. There is tragedy recently in Chennai, and suppose foreign countries help, they send funds to India in this hour of calamity. There is a tragedy in Pakistan, there is a tragedy in Afghanistan, or there is a tragedy in some other country, and India sends funds to help them. These are transfer receipts and transfer payments. This is current account. Now we come to capital account. I told you, in capital account we record all transactions which affect foreign exchange liabilities and foreign exchange assets. We mainly have three: investments from and to abroad. When foreigners invest in India, they bring in foreign exchange, but that foreign exchange is not ours, it is theirs. So, India has a liability to pay back whenever they want to go back to their country by winding up their investments here. Similarly, Indians investing abroad, it is foreign countries' liabilities and it is our asset. So, investments abroad affect assets, investments from abroad, they increase our liabilities. Similarly, borrowings, we borrow from abroad and these borrowings increase our liabilities. We lend to abroad, borrowings to abroad, these borrowings to abroad increase our assets. Then there is a third, decrease in foreign exchange reserve. Just listen carefully, what does it mean?